If I set my stop loss, my profits are locked in and my losses are limited, right? This is one of the most common mistakes made by beginner and experienced traders alike. Lesson number 1. The market makers know where your stop loss is. And it is very common to see a chart like the one on screen where the market maker will artificially make the price wobble. Stop losses are one of the most misunderstood tools and possibly even scams out in the trading world. Let me tell you how I learned this lesson myself.
On the morning of Tuesday, September the 11th, 2001, 19 men boarded 4 internal flights out of Boston, Washington and Newark with a common aim: to hijack the planes and use them as deadly weapons of mass destruction. The first plane, an American Airlines Boeing 767 with 92 passengers and 5 hijackers on board, crashed into the North Tower of the World Trade Center in New York at precisely 8:46 local time. Shortly afterwards, at 9:03, another Boeing 767, this time flown by United Airlines, with 65 passengers and a further 5 hijackers on board, smashed into the South Tower, as millions around the world watched in fascinated horror as the images were captured.
First of all, I'm sorry to have brought up this part of human history, but I want to tell you my story of where I was on this day. It was September 11, 2001, the attacks on the World Trade Center. At this time, I was in Brussels, Belgium, watching in horror at the events unfolding. But here's what happened in the trading world. At the time, I was long the Dow Jones. But in essence, I was buying a basket of the top stocks in the US. I would make money if the market went up, and I would lose money if the market went down. At the moment of these horrible attacks, trading was actually suspended. So although my trading portals were open with brokers, no trades were actually happening. I was long at 10,000 points on the Dow. The spread, which is the difference between the buy and sell prices, had been opened up to levels that made it completely impossible to trade. All stop losses were rendered completely ineffective. There is no way I could enter or exit any trade even 20% below the market. We all had to wait 4 agonizing days before we came back to being able to trade again. If I had a stop, and I never used stops, then the brokers would have exited them pretty much wherever they wanted. Now let's take a step back a little bit. What actually is a stop loss and why do we need one? So really, people are looking for protection, but what are they looking for protection from? Put simply, there are 2 main reasons that people want protection. Number 1 is if the market goes against them in some crazy circumstances, they want to have some kind of protection. And number 2, if they've already got some profits, they want to feel that they can lock in some of those profits and not lose all of them if the market again goes crazy. As always, I need to tell you that I'm not your financial advisor. Please make sure you seek advice if you need it. This video is for edutainment only. I've got a favor to ask you. Smash that like button really hard, and if you're not already subscribed, make sure you subscribe and hit the notification button. By the way, have you heard of this guy called Elon Musk? Of course you have. Well, I've done a study on his book which I highly recommend you read. It's a book by Ashley Vance, and here's the cover of it. Do you know one of the things you can use from his morning schedule that will immediately give you a boost? Well, we're going to mention that later in the video. Can you guess what it is? Okay, back to stops. And scenario number 2. Let's say you bought Ethereum with your broker exchange, and let's say you bought it at $3,000. You've seen the price go all the way up to 4,500 and you want to lock in some profits at say 4,000. Then on one particular time, this happens. Price mysteriously has a spike down, collects your stop, and then the market keeps going up to 5,000. Well, how did that happen? Well, first of all, let me tell you, this happens all the time. So let's understand a little bit more about trading. In order for us to understand how trading works, we need to learn something about what a market maker is. Now, this is a very broad overview. I do warn you that it does get a little bit technical. Do bear with me though, as I'll be giving you a non-technical solution after this. A market maker is there to provide liquidity. It facilitates the ability to buy or sell stocks, crypto, or whatever they are making a market for. Let's say you're a market maker for Ethereum. You can buy Ethereum for $4,000 and you can sell it for $3,950. That would be the buy-sell price. In an ideal world, someone would buy at $4,000 and someone else would sell at $3,950, and the market maker would continue to make money from what's called the spread, which is the difference between these two prices. Behind the scenes, the market maker needs to balance its books. In essence, what you need to understand from the perspective of stop losses is that the market maker makes money the more trades that you do. Okay, back to Elon Musk. Did you work out what you can take from his daily schedule? Well, it's as simple as having a relaxing morning shower. Something you can do, right? Okay, let's get back to the video. Many people are trading with market makers. They double up as brokers or facilitators of your trades. They allow you to be able to trade the instruments, crypto, stocks, or whatever. But now here's the interesting part. Lesson number 1. The market makers know where your stop loss is. And it is very common to see a chart like the one on screen where the market maker will artificially make the price wobble, and that could be of the coin, the currency, the stock, in order to collect your stop. As of course they make money from another trade that's been completed. It is literally low-hanging fruit for them to be able to use. But in trading, it's common knowledge that many brokers are doing something very similar. You need to understand that market manipulation is commonplace even at the highest level. There are countless stories of large banks, I'm not going to name any names here, being caught and fined for, well, let's call them trading irregularities. And again, I'm not going to name any names here. Lesson number 2. There are two kinds of orders that are relevant here. Order number 1 is a limit order. Order number 2 is a market order. A limit order is where we are putting an order in that says, I only want to make this trade if the price hits X, Y, Z. So for example, if I'm holding Ethereum, I could put in an order to sell 1 Ethereum when the price hits $5,000. That is a limit order. That order will only be executed at the level of $5,000 if the price hits $5,000. So there is relatively low risk in this kind of order. A market order is very, very different. A market order is basically an order, in effect, with me standing in the market shouting, hey, anyone want to buy my Ethereum? You then give the market maker a license to pick whoever shouts the best price for the market maker, and not you. So you might end up wanting to exit your trade at $5,000 for Ethereum, and someone offers to pay, $4,950. So maybe they pocket the difference, if that's the best or most convenient price he found. Now, if you have a stop loss, what happens is that a market order is initiated to exit your trade. And if the market is falling, it could be filled at just about any price. Guys and girls, the purpose of this video is not to scare you, it is to educate you. So what is the solution? Well, this is not a trading class, but here are some of the things you need to do. Number 1, absolutely trade with discipline. Disciplined trading and money management is absolutely key. Number 2, in my opinion, you should always be trading long term. Check out the video as to why most people lose money trading crypto. Number 3, you need to exit trades when they are outside of your core holding criteria. So how do you exit trades without stops, I hear you ask? So instead of stops, what I do when I'm holding long-term positions is to put in alerts. These will alert me as to what's happened, and then I will go and make my own decision and exit the trade on my own terms. If I leave a stop loss in, I assume the trade has been taken out. If you operate on this assumption, then you will be fine. Make sure you check out 2 videos. Number 1, why most people lose money trading crypto. And number 2, if you want to set up your own online business, check out this video on affiliate marketing. Take care and stay safe.